Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Energy Transfer stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Energy Transfer transports and stores natural gas, crude oil, natural gas liquids, and refined products. To put it simply, it makes money by transporting oil through its pipelines to various customers. They also own all Sunoco branded gas stations in the US, and there's over 7,000 of those. If you want to invest in just the gas stations, you can simply invest in ticker SUN. Sun's market cap is $3.7 billion. All of Sun's financials are consolidated into ET's financials. Energy Transfer also owns USA Compression Partners. If you only want to invest in USA Compression, just invest in ticker USAC. USAC's market cap is $2.1 billion. Just like Sunoco, all of UAC's financials are combined into ET's financials. Energy Transfer is structured as an MLP, a master limited partnership, pays a lot less taxes than a traditional corporation. To qualify to become an MLP, the business must receive at least 90% of its revenue from natural resources or real estate. The company is headquartered in Dallas, Texas, and was founded in 1996. The ticker trades on the New York Stock Exchange, London Stock Exchange, and Mexican Bolsa. Let's get started with the model. This is a large cap company, 38 billion market cap. They're trading at $12.51 a share, and they have 3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They were generating a healthy amount of free cash flow in 2019 and 2020, over $2 billion. Then the price of oil skyrocketed in 2021, and their free cash flow also skyrocketed to over $8 billion. It did drop in 2022, but it's still a solid $5.7 billion. That's a lot of free cash flow. That's why they pay such a nice dividend. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had nearly $5 billion in 2019, a break even in 2020, $6.7 billion in 2021, and $5.9 billion in 2022. Revenue is a sales for the company, and that dropped from 2019 to 2020. Then it went from 40 billion to 70 billion to 90 billion. Amazing growth. But the company's revenue and profits are really determined on the price of oil. If oil prices get really high, so does this company's revenue and profits. And vice versa. If oil prices get really low, so do their revenues and profits. And if oil prices got below $50 a barrel, this company is likely to lose money. This is the company's income statement from their latest 10K, 2020, 2021, and 2022. And you can see their revenue was $90 billion in 2022, $26 billion from refined product sales, $23 billion from crude sales, $20 billion from natural gas liquids, gathering, transportation, and other is $11 billion, natural gas sales is $8.5 billion, and other $800 million. Gathering and transportation is the midstream part of the oil and production process. Sales is closer to downstream. So when you buy gas at the gas station, that's as far downstream as you can get. Upstream are the companies that actually extract oil from the ground. Upstream is the riskiest part of the oil and production process. Midstream is the least risky. Here's a breakdown of their cost of revenue. $72 billion from cost of products. They don't extract oil. They're not an upstream company. They have to buy the oil from upstream companies like Shell. And then they resell the oil. As you can see here, crude sales, natural gas liquid sales, natural gas sales. They also refine the gasoline. That's also part of the downstream process. And then they may transport it through their pipelines for other companies. They have $4 billion in operating expenses. They have lots of fixed assets. Those pipelines are expensive. They have to be depreciated over their useful life. $4.2 billion in depreciation. SG&A, which includes payroll and marketing, that's $1 billion, and impairment losses, about $400 million. So they do have a lot of expenses, $82 billion. Their operating income is $7.7 billion, which is lower than 2021 of $8.8 billion. So their margins are getting worse. It can be hard to tell on the income statement how well a company's doing because some of these expenses are non-cash items. The statement of cash flows, which we'll look at in a little bit, clears up that discrepancy. They do have a good amount of debt. They spent $2.3 billion of interest on their debt, which is pretty much the same amount they spent in 2020 and 2021. They also had a gain of $257 million from earnings from equity investments. When you own between 20% to 50% of another company, you have to report that company's earnings or losses onto your income statement. So since they own USAC and Sunoco, these are probably their earnings. They do interest rate swap derivatives. They had a gain of $300 million. That's to hedge interest rates so you don't get these big spikes. So their income before taxes is $6 billion. Since they're an MLP, they pay very little in taxes, only $200 million. That's about 3.5% of their EBIT. So really low taxes. Net income of $5.9 billion. So their earnings per share are $1.40, down from $1.89, but it was negative in 2020. Let's take a look at their balance sheet and then their statement of cash flows. This is the asset section of their balance sheet as of 12/31/21 and 12/31/22. Remember, the balance sheet is like a snapshot at a point in time. Statement of cash flows and income statement is for a time period, like for 3 months, 6 months, or a year. The balance sheet is just the value as of a certain date. So as of 12/31/22, they had $12 billion of current assets. This is the liability section, $10.4 billion of current liabilities. So their current ratio is solid, it's above 1. Current ratio is current assets over current liabilities. A good current ratio is usually between 1.2 and 2. A good current ratio lets you know if the company can pay off its current liabilities with its current assets. They can. If they had a current ratio below 1, which some companies have, there may be a concern the company doesn't have enough money to pay off its current liabilities. Current liabilities are debt due within 1 year. If that's the case, that means they may have to take on more debt to pay off the current debt, or possibly sell some stock, or in a bad situation, sell some fixed assets. They keep very little cash on their balance sheet, only $257 million. They have lots of accounts receivables, $8.5 billion, up from $7.7 billion. This is how much money is owed to them by other companies. They have $2.5 billion of inventory. These are the energy products, like oil and natural gas liquids. They have $106 billion of PP&E, property, plant, and equipment. Most of this is their pipeline. I think they have 90,000 miles of pipeline. So that's the original cost, the original expense of those pipelines, or whatever those fixed assets are. And they depreciate those assets each year. So they depreciated $26 billion. So the book value, the carrying value is $80 billion. It's the original value minus depreciation. So for example, if they sold those assets for $75 billion, they would have to pass through a $5 billion loss onto the income statement. If they sold all their fixed assets for $85 billion, they would have to pass through a $5 billion gain onto their income statement. But of course they wouldn't do that because they need this to run their business. A company may do that if it was going into liquidation or possibly just selling one of its fixed assets, not all of them. They have about $3 billion of investments in unconsolidated affiliates. So it's unconsolidated, so it doesn't include Sunoco or USAC because those are consolidated. Unconsolidated means they own less than 20% of those companies. So they can't put it onto the income statement as equity investments. Lease right-of-use assets. These are assets that are owned by another company. Even though they lease these assets, they do carry the value of the assets on their balance sheet. We'll also see a similar amount on the liability section of the balance sheet. Other is $1.6 billion. Intangible is $5.4 billion. When ET acquires a company for more than their book value, more than their balance sheet value, the additional amount, the premium they paid for that company, is goodwill, $2.6 billion. Other intangible assets might be copyrights, trademarks, or sometimes they value what the customers are worth when they acquire a company. So their total assets are almost identical from year to year, about $105, $106 billion. And the liabilities plus the equity section of the balance sheet has to equal this. the balance sheet has to balance. This is the liability section of the balance sheet. It's what they owe. Current liabilities are what they owe within 1 year. Accounts payable is what they owe companies, possibly for products or services they bought from them. An accrued liability is when ET incurred an expense it has not paid yet. That's $3.3 billion. Payroll is an example of an accrued liability. Let's say, for example, in the CEO's contract, they pay him a $120 million bonus, which is equivalent to $10 million a month. Every month, they're accruing debt, $10 million towards his bonus. They didn't actually pay him anything yet, but once the end of the year comes, they're going to pay him $120 million. But they add $10 million to accrued liabilities every single month. So investors know what they truly own and what they truly owe. That's why public companies usually use accrual accounting. If you have a small business, you probably use cash accounting. They have lots of debt, $48 billion of debt, $49 billion last year. Here's the lease liabilities from the right of use assets, $800 million. $3.7 billion of deferred income taxes. These are taxes the company will eventually pay but are not due yet. But they still need to put it on their balance sheet so people know, investors or banks know, what the company will likely pay in the future. Anything below current liabilities are long-term liabilities, debt due beyond 1 year. So it could be due in 11 months, it could be due in 10 years. Some of this long-term debt might not be due for another 10, 15 years. This is their equity section of their balance sheet. Assets minus liabilities equals equity. Or equity minus liabilities equals assets. Or equity minus assets equals liabilities. It's good to know every situation because when you do, it makes things more clear when you look at the numbers. They're an MLP, so they issue units. They don't issue stock. So you're a unit holder. It's like being a partner in a company. They have preferred unit holders, which are similar to preferred stockholders, $6 billion. That's how much they receive from issuing preferred units. And common unit holders, which I'm a common unit holder if you own the stock, and they receive $27 billion from common unit holders. So the partners own $33 billion of the company. If somebody owns between 10% and 50% of ET, say Warren Buffett owns 20% of this company, it will be shown as non-controlling interest on their balance sheet. This is still part of equity, but they just stripped this part out. So their total equity is $41 billion. If you add that to the liabilities, it equals $105.6 billion, which is equal to their assets. Now let's look at the statement of cash flows. Statement of cash flows is broken out into 3 sections: operating cash flows, investing cash flows, and financing cash flows. Let's start with operating cash flows. Operating cash flows is like net income converted to cash, because net income on the income statement is your accounting profit or loss. It's not actual cash, because in 2020 they only had $140 million of profit. But the reason they generate so much cash flow is because they passed through a $2.9 billion impairment loss. So they impaired one of their assets and they had to pass through the loss onto their income statement. That's a non-cash item. So it brings down their net income, but it doesn't affect cash flow. That's why you should look at a statement of cash flows and not just rely on the income statement. They still generated less cash flow in 2020 than 2021 and 2022. In 2022, they reported an accounting profit of $6 billion, but generated $9 billion of cash flow. The way to calculate operating cash flow, you start with net income, then you have to add or subtract the non-cash items on the income statement. We have to add back the $4.2 billion of depreciation. That's an expense on the income statement that brings down their net income, but it's a non-cash item, so we add it back here. We have to add back deferred income taxes, a $386 million impairment loss. And there was a gain on the income statement, a gain from earnings and equity investments. That's also a non-cash item, so we have to minus it out. If they reported a loss on equity investments on the income statement, we'd have to add it back here. And then you have to adjust for changes in working capital. So if you buy a lot of stuff on credit, you use accounts payable, that's like a cash inflow in that accounting period. But when you pay for the accounts payable, it's a cash outflow in that period. They had negative $1.5 billion in working capital. Here's the second section of the statement of cash flows, investing cash flows. And this starts for cash paid for acquisitions. So when you invest in other companies, when you buy companies, They had a cash outflow of $1.1 billion in 2022. In 2021, it was a cash outflow of $200 million. Nothing in 2020. And they pretty much always spend in CapEx, whether they're adding infrastructure like pipelines or maybe just maintaining them, improving them. That all goes into CapEx. $3.3 billion in 2022. It was high in 2021, $5.1 billion. It looks like they sold Energy Transfer Canada and they received $300 million. So that was a cash inflow. They sold some other assets. That's an inflow of $78 million. Distributions from unconsolidated affiliates in excess of cumulative earnings. So remember the earnings from equity investments on the income statement? Those are non-cash items. But if those investments pay a dividend, that is a cash item. And these are the dividend inflows, $187 million in 2020, $167 million, and $62 million. So in 2022, they had a cash outflow of $4 billion in their investing section, $2.8 billion in 2021, about $5 billion in 2020. This is the third section on the statement of cash flows, the financing section. When a company uses debt or equity, it goes into the financing section. They took on $29 billion of debt in 2022, but it looks like they took that on to pay down debt that was due. A lot of companies do that. They continue rolling debt year after year. Because say you had a big debt payment, you had to pay off your car, you had a car loan, but you had to pay the entire loan back after 3 years. And the 3 years are up and you have to give $20,000, but you don't have the money, so you just take another car loan for $20,000 to pay off the old loan. Hopefully the interest rates are lower on the new loan. If they are, it's a win for you. If the interest rates are higher, then you're losing out. It's not a good use of debt. And then they pay lots of dividends. Distributions to partners, like common stockholders like me, they paid $3 billion in 2022, $1.9 billion in 2021, $2.8 billion in 2020. Distributions to non-controlling interests are the dividends to the non-controlling interest holders. Remember in the equity section, I said it looks like somebody owns between 10% and 50% of this company. They're the non-controlling equity holder. So they also get a dividend. Their dividend was $1.5 billion. In their financing section, they had a cash outflow of $5 billion. Last year was a cash outflow of $8 billion. That's because they paid down a lot more debt than they issued. And in 2020 was a cash outflow of $2.4 billion. It looks like they sold some stock in 2020 and raised $1.6 billion. That's why the cash outflow is lower in 2020 than 2022. Let's look at the capital structure. They have $33 billion of equity, $49 billion of debt. They're 40% equity, 60% debt. Their net debt is $49 billion. And I gave them the middle whack on Finbox, 14.8%. That's a really high whack. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $46 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $44 billion. We divide that by 3 billion shares. And we get a calculated stock price of $14.45. They're trading at $12.51, so they're trading at a 13% discount. It's a buy according to the model. 4 analysts projected their 2025 revenue to be $81 billion. 2024, their projection was $87 billion. 2023, it's $85 billion. I continued this trend into 2026 and I got $75 billion. That's how I got their future revenue estimates. The past 4 years, they convert on average 7% of their revenue into free cash flow. So I multiplied their future revenue estimates by 7%. That's how I got their future free cash flows. The last DCF video I did on ET was a little over a year ago. They were trading at $9.70. My projection was $13.49. So it's getting close to my projection. At the end of 2021, I sold one of my businesses and I used the cash to invest in a few companies. Johnson & Johnson, which is almost flat. Meta, which is down 36%, kind of sucks. I'm negative 32,000. But my best performing by far is ET. I paid $863, now it's $12.51. That's a 45% return. $22K on that investment. I put $50,000 into them. I put $100K into Johnson & Johnson and $100K into Meta. And now ET is past Meta. Plus I got dividends from ET, so it's even more than this. But unfortunately I'm not psychic. I would have put it all into ET. But of course you never know which way the market's going to move. The website Simply Wall Street values the company at 17. They're saying it's 28% undervalued. 7 analysts priced this stock and the average price target is 17. The low is 15, the high is 18. Another 18 analysts priced this stock, and the average price target is $16.58. This is where the stock has been trading the last 5 years. In mid-2018, it got close to $20 a share, and then it got real low down to $5. I wish I could have picked it up around here, but I had no money at this point. All my stocks were down. I did get it around this point in the beginning of 2021, which wasn't a bad time to get it, because now I'm up close to 50%. And oil is just one of those things that are never going to go away. Companies will go obsolete, out of business, but oil will always be around. In the past 5 years, this stock is down 12%, but if you add the dividends, it's probably up close to 12-15%, while West Texas Intermediate in the same time frame is up 30%. So I guess the reason this is lagging, West Texas Intermediate, is because of the big dividends it pays. If they didn't pay any dividends, the gap will be a lot smaller. They did cut their dividend from 31 cents to 15 cents in 2020. That was the rough year, the first year of COVID. But they have brought it back to 31 cents just recently. So they have a great yield, 9.75%. The way you calculate the dividend yield, you multiply the last dividend by 4, so that's $1.24, and you divide by the stock price. So this yield is if you bought the stock today. But if you bought the stock when I bought it, my yield is much higher because my cost basis is lower. But if you bought the stock when it was trading at $20 a share, your yield is much lower. Theoretically, everyone can have a different yield because we all have different cost bases. Even if we bought it a half hour away from each other, we probably bought it at different prices. And they could easily afford this yield. It's 65% of their free cash flow, 63% of their net income. The payout ratio is their annual dividend payment, $3.7 billion. That's 31 cents times 4, $1.24, times the number of shares, 3.7 billion, over their annualized net income of 5.9 billion. And look at their dividend yield the last 10 years. It was 20% when the stock crashed in 2020, but even back in 2016, it was about 15%. The forecast is for the yield to be 10.7% by 2025. That's a really high yield for such a strong and stable company. They have a pretty high beta, 1.73, so the stock moves almost 2 times the market. It's gone up 11% in the past 52 weeks, while the S&P is down 8.5%. 52-week low is 915, the high is 1367, and the stock is trading slightly below its 50-day, above its 200-day moving average. This is a pretty popular stock. Over 13 million shares have been traded on average the past 3 months. Of the 3 billion shares outstanding, 2.5 billion are on float, 38% are held by institutions, 17% by insiders, and about 2% of the shares are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be down to $4,400 today. It looks like a bad time to invest. It's really a timing thing with these oil stocks or commodity stocks. If you time it wrong, you may never be profitable. The CEO's annual salary is $1.4 million. Their total compensation package is close to $20 million. Lots of insider activity, all buying, no selling, mostly by Kelsey Warren, the CEO, and he buys lots of shares. He bought $2.5 million at $12, so he's up a little on that. He bought $1.7 million at $13, down a little there. 43% of the company is held by the general public, 37% by institutions, 14% by insiders, 6.5% by public companies, and 0.2% by private companies. Their employee count was pretty high back in 2018. When it drops a lot like this, that's usually because they sold a part of their business. It's pretty unlikely they laid off 60% of their workers in a 1-year time frame. There are around 13,000 employees, and it's been that number for a few years now. The biggest shareholder is the CEO, Kelsey Warren, 9.4% of the company. His valuation is $3.6 billion. Next biggest shareholder is Centerpoint, Ray Davis, Blackstone, Harvest Fund, Invesco. I did a video on them. Alps, Morgan Stanley, Goldman Sachs, and Natixis. The fact that these big, important companies like Goldman Sachs own the stock should make you feel more comfortable owning the stock. The best way to look at ratios is to compare them to companies in the same industry. There are 52 companies in the same industry as ET, and if ET has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They have lots of blue because they're a great company. They spend a lot on CapEx, as a lot of midstream companies do, $3.4 billion. They do have more debt than equity. For every dollar of equity, they have $1.50 of debt. but their debt to equity ratio is better than average. Average is 2.2, they're 1.5. They pay a really nice dividend close to 10%, average is 5.5%. That's why people invest in midstream companies, for the really high dividend. They generate lots of free cash flow. They rank 7th in market cap at $38 billion. Enbridge, the Canadian company, is number 1 at close to $80 billion. Look at their ratios. Their price to book is 1.1. The average is 8.8. PE is 6.4. Average is 18. Price to free cash flow is 7. Average is 9. And look at their price to sales. A price to sales of 0.5 means the company generates twice as much revenue as their market cap. Since they're 0.4, they generate more than double their market cap in revenue. Their market cap is $38 billion. If you double that, that's $76 billion. They generate more than $76 billion, obviously, in revenue, $90 billion. They're still growing a lot, more than most companies on this list. Their average 5-year annual revenue growth rate is 17%. Their ROA is lower than average. ROA is net income over assets. It's 4%. That's how well you use your assets to generate a profit. ROE is net income over equity. It's how well you use your equity to generate a profit. The company just did a presentation this month. Let's go through some of the slides. In the fourth quarter of 2022, record NGL, natural gas liquids fractionation. Fractionation is a separation of liquids, gases, or solids into their components. It's like being a cook. It has to be a certain recipe to get the result, to get the type of product, the energy product they want. And it's a very expensive, time-consuming, and laborious process. And fractionation is just one part of it. In just one day of fractionation in Mont Belvieu, they reached more than 1 million barrels for the first time. That's for the first time ever, and this company's been around, I think, 26 years. They had another record in midstream in the fourth quarter of 2022, the volume of energy they gathered. The Nederland terminal also set a record in the fourth quarter of 2022. Ethane exports. Ethane is the simplest hydrocarbon. It's the second most important ingredient of natural gas. It's mainly used to produce ethylene, and you can find it in products like paints, varnishes, adhesives, and plastics. Now their Gulf Run pipeline is in service as of December of last year. The Grey Wolf processing plant is in service, and they finally completed Oasis optimization. That's more than 60,000 cubic feet per day at the Permian Basin. We'll talk more about the Permian Basin a little later. Their EBITDA guidance for 2023 is around $13 billion, and their expected growth 1.6 to 1.8 billion. They had record EBITDA for full year 2022, $13.1 billion, and they announced plans to acquire the private company Lotus Midstream. And this is going to really improve their footprint in the Permian Basin. The Permian Basin is in Texas. That's where this company is, in Texas, Lotus Midstream. The Permian Basin is the largest oil basin in the US. So the bigger footprint this company has, the better, especially there. And remember we talked about the dividend earlier, how they raised it back up to the 2020 levels? That's what this note is referring to. With recent distribution increase, distribution is dividends, the level is now restored to its first half of 2020. Their senior unsecured debt rating on positive outlook with all 3 rating agencies. The higher the credit rating, the lower the interest they pay. If you have a AAA rating, you pay a lot lower interest on your debt than BBB, for instance. They recently executed a letter of intent with Occidental Petroleum. That's a really big company. This is for the Magnolia Hub in Allen Parish, Louisiana. Now ET and Oxy have long-term commitments with industrial customers in this part of Louisiana. Here's a slide on Lotus Midstream, a company they may acquire. It's a fully integrated crude pipeline and terminal system in the Permian Basin. It's 3,000 miles of pipeline that connects to ET's network and major hubs. Those major hubs are Cushing, Midland, Colorado City, Wink, and Crane. This adds 2 million barrels of crude oil storage capacity in Texas. And Lotus has a 5% equity interest in the Wink to Webster pipeline. So if they acquire Lotus, they acquire that as well. And these are long-term fixed rate contracts. Those are the best. So it's going to add lots of free cash flow to ET. And this should close soon in the second quarter of 2023. And we're in the second quarter right now. So it could close this month, next month, or possibly in June. Here's the Permian Basin. And ET has an extensive footprint and they're trying to grow it. They converted 55 miles of existing NGL pipeline to rich gas service. Phase 1 was completed back in October 2021 and expansion was in the first quarter of 2022. That's the Permian Bridge pipeline. The Grey Wolf and Bear processing plants, These generate 200 million cubic feet per day of cryogenic processing plants. Grey Wolf went into service in December of last year, just a few months ago, and Bear is expected to be in service this quarter. One of ET's big acquisitions was Enable Midstream. That closed in December 2021. They closed the acquisition of Woodford Express in September 2022. They announced Lotus Midstream, which we talked about already. That should be closing any day. This is Energy Transfer's asset base in the US. So you can see they're really concentrated in Texas for obvious reasons, but they touch lots of parts in the US. They have the Marcus Hook Terminal, Nederland, and the Houston Terminal. There's the Eagle Point Terminal. That's in the northeastern part of the United States. That's over here. The Marcus Hook right here. Midland, Texas. Cushing. Nederland. It's really hard to see these. Houston is over here. You can see they're heads above their competitors. Total return in 2022 is 56%. That's compared to their price return of 44%. And these are the major midstream companies in their industry. This is a cool graph. Here's a breakdown of their adjusted EBITDA. 17% from crude oil, 23% from NGL, natural gas liquids and refined products, 25% by midstream, 24% by natural gas interstate and interstate transportation and storage. And the companies they own, Sunoco and USAC. Of course they own pieces of other companies, but those are the two main ones they own. That was 11% of their EBITDA. This shows us their major growth projects since 2017. Here's Permian up here, the Permian Express 3, the back-end pipeline, Rebel 2 plant, Arrowhead 2 plant. The Bear processing plant is a big one for 2023. Last year they got Grey Wolf, Gulf Run, and Cushing done, amongst others. Here's the ownership breakdown. 49% of the companies held by retail investors, like me and you, 13% by insiders, and 38% by institutions, like other companies. They do have a lot of insider ownership, 13%, which is a lot more than their peers. So the insiders have a lot of faith in this company. They're willing to put their money where their mouth is. So am I. That's why I bought the stock. Here's a visual of some of their big acquisitions. In 2012, Sunoco gas stations. 2017, Sunoco logistics. Enable Midstream was a big one in 2021. This statement is definitely true. Management has a proven track record of successfully integrating acquisitions. They do it really well, better than almost any other company. And they're also trying to expand their alternative energy, because we know that's the future. Renewable fuels, solar, repurpose existing assets to make them more efficient, using solar and wind projects. They own 36% of the back-end pipeline, 88% of Permian Express partners, half of White Cliffs. And here's their crude oil terminals. Nederland, 30 million barrel capacity. Houston Terminal, 18 million. Cushing, 8 million. Northeast, 6 million. Patoka, 2 million. And Midland, 1 million. Lots of capacity. They have 11,300 miles of crude oil trunk and gathering lines. Here's a slide on their NGL and refined products segment. NGL storage is 83 million barrels. NGL pipeline transportation is 5,650 miles. They have 3,700 miles of refined products pipeline and 37 refined products marketing terminals with 8 million barrels storage capacity. Here's a slide on their midstream segment. They had record volume in Q4 2022. Their processing capacity at Permian is 2.8 billion cubic feet per day. Mid-continent Panhandle is 3.6 billion. North Texas is 700 million, 2.4 billion in South Texas, 2 billion in Louisiana, and 200 million in Eastern. They have 53,500 miles of gathering pipeline. Tons of pipeline. I think total for all their pipelines is about 90,000 miles. So to summarize, I have them trading at a 13% discount, and I'm really bullish on this company, as you can tell. I'm long-term on them. I think they have a great business model. They do lots of acquisitions. They're always growing. And everything we do is controlled by oil. As much as we're trying to get away from it, lots of oil needs to be used to get closer and closer to getting away from it. Because lots of oil is being used to build out the infrastructure for green initiatives. That's why I like them a lot, and I like this industry. I rank their free cash flow 6 out of 10, their revenue 9 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.